Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a look at a different aspect of the investment landscape and consider how the lessons taught by the man widely considered to be its founding father, Benjamin Graham, are still relevant today. In this episode, we continue on from our previous look into the life and times of perhaps the most famous and successful investor of all time, Warren Buffett, this time taking a deep dive into his sidekick, the late great Charlie Munger. We shall consider the differing personalities and investment styles of Graham and Munger, the two men who most shaped and influenced Buffett on his journey to investment superstardom, and to judge how Buffett would have fared without these two great men in his life. So without further ado, let's get right down to another lesson in value investment as inspired by Benjamin Graham. The paths of Warren Buffett and the man who would go on to be his right-hand man at Berkshire Hathaway, Charlie Munger, unknowingly crossed very early on in life. Munger, who like Buffett had grown up in Omaha, Nebraska, had worked in the grocery store belonging to Buffett's grandfather as a teenager. It would, however, be another 2 decades before the two were formally introduced. Munger's path to becoming one of the two main architects in creating one of the biggest conglomerates the world has ever seen began in 1943. With his stint in the US Army Corps. The high score he achieved on his Army General Classification test marked him out as a man with academic potential, and as a result was posted to Pasadena, California to study meteorology, the town he would later go on to call home. At the conclusion of the Second World War, Munger took full advantage of the GI Bill, the scheme set up to assist returning veterans to assimilate back into society. This allowed Munger to study for a number of advanced courses through several different universities. Munger, however, had set his sights firmly on attending Harvard Law School, the university at which his father had studied. Munger excelled and graduated as a Doctor of Law in 1948. After moving back to Pasadena with his young family in tow, he worked for a number of years for the law firm Wright and Garrett. It was only in 1962 that he broke out on his own, setting up his own partnership specialising in real estate law named Muller, Tolles and Olson. However, by this point in time, something very significant had occurred that would divert Munger's attention from the practicing of law. He had met his intellectual soulmate, Warren Buffett. The two men had been set up to meet by a mutual acquaintance at a dinner party back in Omaha in 1959. The two had immediately got on like a house on fire, and so began a conversation on investment and everything else that would go on to span over 6 decades. Munger was intrigued with what Buffett was doing with his investment partnerships back in his old hometown and began to wonder if he could do something similar in California. Munger went on to set up his first investment company in 1962 called Wheeler, Munger and Company. Buffett later claimed in his essay, The Super Investors of Graham and Doddsville, that the firm would go on to achieve compound annual returns of some 19.8% between 1962 and when the partnership was finally closed down in 1975, as compared to just 5% annual gain for the Dow as a whole. Whilst the regular conversations between Munger and Buffett had continued to go on in the background since they'd first met, it was not until 1978 that the two would become professionally entangled, with Munger joining Buffett's Berkshire Hathaway as vice chairman. Munger had been somewhat frustrated by Buffett's penchant for the cigar butt companies, so beloved of his teacher and mentor, Benjamin Graham. Whilst he was slowly evolving away from his mentor, even at this stage of his career, Buffett could not shake his love for a good cigar butt, a troubled, unloved business with perhaps just one puff left in it, but a puff that could be had almost for nothing. Munger had never really been interested in searching for such unattractive businesses, even if they could be had for less than their liquidation value. Munger much preferred quality businesses, even if they weren't available at knockdown prices. He was especially attracted to the ones that had long-term competitive advantages that were virtually guaranteed a bright future ahead. Whilst Buffett would never really get over his love for a downtrodden business available on the cheap, he realised that his business had reached such a scale that finding a home for his money purely in cigar butt opportunities was impossible. And to Buffett, Munger's approach seemed the next best thing. Munger's investment style broadened his horizons immensely. Instead of having to scratch around trying to find unloved businesses with market capitalisations of just a few £1 million, he can now look for quality businesses with bright futures that could absorb the tens or even hundreds of millions of pounds of Berkshire Hathaway's capital. It seems clear to me that Buffett would have eventually been forced down this route, with or without Munger's early influence, but meeting him so early in his career most certainly put his evolution away from the Graham-style businesses he was formerly focused upon on fast forward. Whilst Munger in some ways had a very different investment outlook to Graham, it would still be fair to label him a value investor. He was still looking to obtain value in the businesses he purchased, but rather than look for it at the cigar butt end of the market, he would look for value at well-functioning businesses whose exciting prospects had yet to be fully realised by the markets. Buffett quoted Munger as telling him, "Forget what you know about buying fair businesses at wonderful prices. Instead, buy wonderful businesses at fair prices." I would put it like this. While Graham was applying his trade at the bargain basement end of the market, Munger was looking for high-end value opportunities. But apart from this important distinction, Munger and Graham had very similar philosophies on investment. Among other similarities, both believed in concentrating their portfolios in just a handful of promising stocks, rather than diversifying so far and widely that the success of their best ideas would hardly move the dial on their portfolio's overall performance. And both believed in the importance of the investor being rational, objective and dispassionate. In other words, that the most important factor in the practice of successful investment is that the investor should be in control of their emotions. It is clear from what we've seen that both Graham and Munger were huge influences on Buffett as an investor, and it is proof that value investment can take more than one form. It must also be considered that whilst Buffett has had many influences in his career, it has not been a one-way street. Buffett also shaped Munger as an investor. Clearly, the foundations laid down by Graham have been the basis of both Buffett and Munger's investment philosophies, and as is always the case with these things, people always go on to form their own take on it, adapting things to suit their own reality. This begs the question, should the would-be value investor today aim to emulate Graham's or Munger's approach? The thing for me is that Graham's approach is much more suited to those new to investment, for it provides an underpinning that can be adapted once that investor gains an experience. Graham's approach in seeking out attractive businesses trading at less than they should is pretty much black and white. Other than the ability to crunch the numbers, it requires very little in the way of skill. But not many, certainly in the early dawns of their investment career, will have the skill and judgment to assess the more qualitative aspects of a business. Buffett and Munger are investment geniuses, remember, and mere mortals cannot hope to be at their level of acumen. For the rest of us who do not need to find a home for the tens of billions of dollars, as do Berkshire Hathaway, we should be content that there are abundant opportunities for investors using the Graham approach. So abundant, no doubt, that Buffett himself will be jealous, stuck as he is with a few opportunities big enough to warrant his time and effort. That is all for today, folks. I hope you've enjoyed the episode and that it's added something to your knowledge of value investment. If it has, please do consider adding to playlists in order that you need not miss a future edition. Thanks for tuning in. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.